Welcome to the world of stock market analysis. Here, every chart tells a story, and every movement on the screen is a clue to what might happen next. Those red and green rectangles on financial charts, they're called candlesticks, and they reveal the story of price movement. Each one is like a snapshot of market action, capturing the emotions and decisions of countless traders. Candlesticks are a visual language, showing the ongoing battle between buyers and sellers. They make the invisible tug-of-war in the market visible so you can see who's winning at any moment. Learning to read them gives you a powerful edge in understanding the market. It's like learning to read between the lines of a book, uncovering hidden meaning and intent. Each candlestick represents a specific time period, like a day or an hour, and packs a lot of information into a single shape. The body and the wicks together tell you how high and low the price went and where it started and finished. Unlike simple line charts, candlesticks show the opening, closing, highest and lowest prices for that period. This extra detail helps you see the full picture, not just a single point. This lets you see not just where the price ended but the journey it took, capturing the drama between bullish optimism and bearish pessimism. Every candle is a record of struggle and momentum. With candlesticks, you get the full narrative, not just the final result. You can follow the market's story as it unfolds, candle by candle. This visual storytelling helps traders spot patterns and anticipate future moves. Recognizing these patterns can be the difference between reacting and predicting. For beginners, candlesticks turn confusing numbers into clear, interpretable pictures. Suddenly, the market's movements start to make sense and you can read its signals with confidence. At a glance, you can sense the market's mood. Was it a day of strong buying or did sellers dominate? The color and size of each candle give you instant feedback. As you get familiar, you'll notice recurring patterns that can help you time your trades. These patterns are like footprints, showing you where the market has been and hinting at where it might go next. These patterns are clues left by the market's collective behavior. By learning to spot them, you can start to anticipate opportunities and risks before they become obvious to everyone else. This guide will break down everything you need to know, from the basic parts of a candle to the powerful patterns they form. By the end, you'll see the market in a whole new light, ready to make smarter, more informed decisions. To read candlestick charts, start with the basics, the body and the wicks. These two elements are the foundation of every candlestick, and understanding them is crucial for interpreting price action in any market. The body is the thick part of the candle. It shows the range between the opening and closing prices for a specific time period. If the body is filled or colored, it usually means the price closed lower than it opened. If it's hollow or a different color, the price closed higher. A long body means strong buying or selling pressure during that period, indicating clear momentum. On the other hand, a short body signals indecision or little movement, suggesting that buyers and sellers were more evenly matched. The wicks, or shadows, are the thin lines above and below the body. They show the highest and lowest prices reached during the session, even if the price didn't stay there for long. The upper wick marks the highest price reached. The lower wick marks the lowest. These extremes can reveal where buyers or sellers stepped in and changed the direction of price. Long wicks mean the price moved a lot but was pushed back before closing, signaling volatility and possible reversals. Short wicks suggest price stayed close to the open and close, showing stability. For example, if a stock opens at $100, closes at $105, but dips to $98, and spikes to $108, the candle's body and wicks tell the whole story, showing not just where the price started and ended, but the full range of market action in between. A long upper wick with a small body. Buyers tried to push the price up, but sellers pushed it back down. Momentum may be fading and a reversal could be on the horizon. A long lower wick. Sellers drove the price down, but buyers stepped in and forced it back up. This often signals potential support or a bullish reversal. The relationship between body and wicks reveals the market's emotional state, whether traders are confident, fearful, or uncertain. By analyzing these shapes, you're reading the psychology of buyers and sellers and gaining insight into what might happen next. Candlesticks make it easy to spot when the market is struggling, consolidating, or about to reverse. Recognizing these patterns early can give you a valuable edge. Mastering this simple structure is the first step to understanding price action and making more informed trading decisions. Every candle is a snapshot of the market's mood, a visual summary of the battle between buyers and sellers in that moment. The color of a candlestick's body instantly tells you the price direction, making it one of the quickest ways to gauge what's happening in the market at a glance. Green or white means the close was higher than the open, a bullish sign. This suggests buyers were in control, pushing prices upward throughout the session. Red or black means the close was lower, a bearish sign. Sellers dominated, driving prices down from the opening level. A series of long green candles signals strong buying and an uptrend. This pattern often attracts more buyers, fueling further momentum. Long red candles show aggressive selling and a downtrend. When you see several in a row, it's a clear warning that sellers are in control. The color gives you a quick read on market sentiment: green for optimism, red for caution. This visual cue helps traders react quickly to changing conditions. The size matters too. A long green candle means buyers dominated. A long red candle means sellers took over. The longer the candle, the stronger the conviction behind the move. Short candles, regardless of color, indicate indecision or a pause in the trend. This often happens before a big move, as traders wait for new information. Remember, the color scheme can be customized, but the meaning is always about the relationship between open and close. No matter the colors you choose, the story remains the same. Bullish candles, close above open. This is a sign of strength and positive momentum. Bearish candles, close below open. It's a clear signal that sellers have the upper hand. This simple system makes candlestick charts intuitive and fast to interpret, even for beginners. You don't need to memorize complex formulas to understand what's happening. You can instantly assess price action and sentiment, no need to scan endless numbers. The visual nature of candlesticks makes analysis more accessible and less overwhelming. That's why traders love candlesticks for quick, effective analysis. They turn complex data into clear, actionable insights. Candlestick charts originated in 18th century Japan, not on Wall Street. Munehisa Homa, a rice trader, invented them to understand market psychology. He tracked opening, high, low, and closing prices, creating the first candlestick shapes. Hama realized emotions, fear and greed drove prices as much as supply and demand. His charts revealed patterns invisible to others, helping him predict price moves. Hama's methods made him legendary, and he wrote one of the first books on market psychology. His principles, known as the cicada rules, are the foundation of modern candlestick analysis. For centuries, this technique was a Japanese secret. In the 1980s, Steve Nissan introduced candlesticks to the West, and they quickly became the global standard. Today, candlestick charts are the default for traders everywhere, a testament to their power. Let's explore a key candlestick pattern, the doji. A doji forms when the opening and closing prices are nearly the same, creating a tiny or non-existent body. It looks like a cross or plus sign, signaling a standoff between buyers and sellers. On its own, a doji means indecision. After a strong uptrend, a doji can warn that buying momentum is fading, a possible reversal. After a downtrend, it can signal that selling pressure is easing, potential for a bounce. Traders watch for dojis at trend extremes as early warning signs. Variations like the dragonfly and gravestone doji add nuance, but the core message is the same. The trend is losing steam. A doji is a market pause, a moment to watch for the next move. Recognizing dojis helps you spot when the market is at a turning point. It's the market taking a breath before deciding its next direction. Two powerful single candle patterns are the hammer and the hanging man. Both have a small body at the top, a long lower wick, and little or no upper wick. The hammer appears after a downtrend. Sellers push prices down, but buyers fight back, closing near the open. This signals a potential reversal upward. The hanging man appears after an uptrend. Sellers show up, creating a long lower wick, but buyers recover. It warns the uptrend may be ending. The color matters. A green hammer or red hanging man is more potent. Always wait for confirmation, a strong candle in the new direction, before acting. These patterns show a dramatic shift in control between buyers and sellers. Spotting them can help you catch major turning points. They're visual alerts that sentiment is changing. Use them to anticipate reversals and adjust your trades. Engulfing patterns are two candle signals of a trend reversal. A bullish engulfing pattern appears after a downtrend. A small red candle is followed by a large green candle that completely engulfs it. This shows buyers have taken control, erasing the previous day's losses. A bearish engulfing pattern appears after an uptrend. A small green candle is swallowed by a large red candle. Sellers overpower buyers, signaling a potential drop. Engulfing patterns are decisive, not indecisive like dojis. The second candle's body fully covers the first, showing a clear shift in momentum. Bullish engulfing sentiment flips from bearish to bullish, bearish engulfing bullish to bearish. When these patterns form, especially on high volume, they're strong signals a new trend is starting. Watch for them at the end of trends for powerful entry or exit points. Recognizing candlestick patterns is a practical skill that sharpens your trading. These patterns reveal market psychology and help you anticipate price changes. Use them to time your entries and exits more precisely. For example, wait for a bullish engulfing after a pullback to confirm an uptrend before buying. Spot a bearish engulfing at a rally's peak? That's your cue to take profits. Candlestick patterns also help with risk management. Set stop losses just beyond key candle wicks. If the price breaks that level, exit quickly and limit your loss. This visual reference makes stop-loss placement more effective. Candlestick analysis works on any time frame and any market: stocks, forex, crypto, and more. The psychology behind the patterns is universal. Once you master them, you have a versatile tool for any trading style. Candlesticks let you interpret price action directly. No need to rely on news or opinions. We've covered the anatomy of candlesticks and the stories told by patterns like the doji, hammer, and engulfing. These shapes are a visual record of the battle between buyers and sellers. Candlestick charting, born from Japanese trading wisdom, is now essential for traders worldwide. Remember, candlestick patterns show probabilities, not guarantees. The best traders combine them with other tools: trend lines, volume, support, and resistance. Don't rely on a single pattern. Use them as part of a broader strategy. Practice is key. Study charts, spot patterns, and see how they play out. Backtesting builds your confidence and sharpens your eye. The more you practice, the more intuitive reading charts becomes. Candlestick analysis demystifies price action and encourages disciplined trading. Mastering this language is your first step towards smarter, more confident decisions in the market.